What's up, YouTube? Welcome back to Not Dumb Money. In today's video, I'll talk about Electronic Arts, or EA. I'll talk about why I like the gaming industry and why I picked EA over other gaming companies. But first, if you're not a subscriber, please show me some love and subscribe. Don't forget to hit that notifications bell so you don't miss out on future videos. Do it! That would be awesome! And if you're already a subscriber, well, hey, that's what's up. Okay, so why the gaming industry? Well, the global video game market was worth more than $150 billion last year, and it's expected to grow at an average rate of 13% over the next 7 years and become a $350 billion industry by 2027. Esports is also growing very fast. Global esports revenue was around $1 billion last year. Esports is expected to grow at a rate of more than 25% until 2027, exceeding $5 billion in size. Esports viewership is estimated to grow from 454 million viewers last year to more than 600 million viewers by 2022, representing almost 15% of all sports viewership globally. The League of Legends World Championship Finals last year was watched by more people than the Super Bowl.
So Alexa does so, but it's at the cost of Chris Blind. Heroes Edwards comes into him, is chasing forward. That's already a kill onto Yankos. This could be it. It's going down, and Fun plus Phoenix are your world champions.
So after I was convinced that I wanted exposure to gaming, the next step was to decide on which stock I was going to pick. One option is the Gamer ETF, which includes 90 different holdings across the gaming industry. I didn't want to spread my bets on gaming that wide. I wanted to try to pick one of the winners. I had a short list of 7 companies: EA, Activision, Capcom, Nintendo, Ubisoft, Tencent, and Take-Two. I decided Capcom and Ubisoft, with market caps of $6 billion and $10 billion respectively, are too small, so they're out. I also decided to exclude Tencent because they're diversified, and although they own League of Legends through their stake in Riot Games, about half their revenue comes from non-gaming businesses, such as advertising, social networks, fintech, cloud services, and more. So the final list is EA, Activision, Nintendo, and Take-Two. Here's my very basic patent-pending comparison table. We'll take an initial view by seeing who scores the highest. We'll give 2 points to each company that has the best metric in each category, and 1 point to each company that has a better than the median metric for each category. First up is the PE ratio. EA has the lowest PE ratio by far after the latest blockbuster earnings. Nintendo is also under the median. That's 2 points for EA, 1 for Nintendo. Next up is the forward PE ratio. Nintendo has the lowest forward PE ratio, and EA is under the median. 2 points for Nintendo and 1 more for EA. Next is the PEG ratio. EA has the lowest PEG ratio and Activision is under the median. 2 more points for EA and Activision gets on the board with 1 point. Let's look at their profit margins next. EA has the highest profit margins and Activision is second. 2 more points for EA and 1 more point for Activision. Let's look at their past earnings growth now. Nintendo's earnings have grown an average of 80% over the past 5 years, way more than any of the other companies. EA is a far second with an average growth rate of around 31%. 2 more points for Nintendo and 1 more for EA. Finally, let's look at their expected growth moving forward. Activision is the leader here with an expected growth rate of 24% over the next 5 years. We can finally talk about Take-Two as it has the second highest growth rate. 2 more points for Activision and Take-Two is finally on the board with 1 point. And we have a winner. So after this super simple assessment, EA is the company I want to look at more closely. Again, guys, this assessment has many flaws, but I like to use it just to guide my thoughts. So, EA has a strong catalog of games. Games such as The Sims 4, Apex Legends, Madden, and others had record high playing times earlier this year. Unlike many of the other companies, EA has a solid list of annual releases across their EA Sports games, and this provides a steady stream of predictable sales. I like predictable recurring revenue. While other game developers are focused on standout hits, EA does not carry the same risk as others. Companies that rely on a smaller number of hits are riskier. With their IP partnerships, EA is able to outsource marketing costs to sports leagues and studios. For other companies, they carry this marketing burden on their own. EA just had a blowout quarter with their biggest sales ever. Revenue was up 78% and earnings grew nearly 6 times from last year. I think they'll continue to grow from here. They have a solid balance sheet. They don't pay dividends, but are buying back a small amount of shares at a steady pace. Sure, they have greedy management, but thankfully shareholders rejected a new round of stock awards. Their CEO is already one of the highest paid in the industry, so I don't think he'll be going anywhere. Many of the analysts covering EA have buy and outperforming ratings with price targets that are above the current stock price. Needham increased their price target from $150 to $165 last month. All right, that's it. We're done. Thank you so much for watching. What are your thoughts on EA? Are you bullish? Bearish? Please let me know in the comments. And if you like this video, please do me a huge favor and hit that like button and subscribe. Your support would be amazing. As always, it's been a pleasure. Much love. Peace.